Hey everybody, it's Ken McElroy here, and I'm very excited to have my partner and my friend George Gammon on. Welcome back, George.
Hey, thanks for having me, Kenny. It's always a pleasure to talk, my friend.
If you're a real estate investor, what are you looking at right now?
Well, I think you got to pay attention to macro, to your point. Like, there are so many real estate investors that just got ran over in 2008, 2009, 2010, whenever it was, because they were completely oblivious to the macro landscape in 2005, 2006, 2007. And there were so many signals out there. And you say, George, I don't know about those mortgage-backed securities. I'm not that much of an expert. I'm just an apartment guy. I'm just someone who borrows money from a bank, does improvements. I'm just like a mini Ken McElroy, or even like at that level of Ken McElroy. And that's just my business. So there's no way I could have known about all of these derivatives like mortgage-backed securities back in 2006. That's not what I'm referring to. All you would have had to pay attention to is something very, very simple called the yield curve. And that's simply, what is the 10-year Treasury yield relative to the 2-year Treasury yield? And we have seen time and time and time again throughout history that when the yield curve is inverted, meaning when short-term interest rates are higher than long-term interest rates, that's a huge red flag. And every single time when we see this, we have a recession. And I would say when we see an inversion to the degree to which it is inverted right now, we see a recession, or a hard landing, if you will, 100% of the time.
The ripples in the economy are starting to show up, and the cities and the counties are going after the landlords. With higher, with higher costs. That's what's starting to show up. Does that make sense?
Yeah, absolutely. I think you hit the nail on the head. And this is an argument that really is incomplete when I hear it from, let's say, the real estate bulls. And they'll say, and they're spot on, obviously, that, hey, look, you've got all these people in a 3% 30-year fixed rate mortgage. There's no way they're going to sell their house. And they're going to be forced to, because their mortgage payment is going to be the same for the next 40 years, or 30 years, excuse me. So this means that there's always going to be very, very low supply. So the home prices or real estate prices will remain elevated forever, regardless of what incomes are doing. See, what this misses is quite a few things. First and foremost, it assumes that your only cost of owning a piece of real estate is the mortgage. But to your point, it's not. There's a lot of other costs. You got your maintenance costs. You've got your property taxes. You've got your insurance. So just because your mortgage payment stays the same, if all of these other costs go up, it could still put you into a position where you're negative cash flow. And therefore, you're put into a position where you have to sell. And I'm talking about an owner-occupant, or I'm talking about a real estate investor. You see, now the next argument that you always hear on the single family side is that, oh, George, well, 40% of the people out there, well, they own their property outright, so they're never, ever, ever going to have to sell. Really? Well, what happens when they lose their job in a recession and they can't put food on the table? And the only asset they have is the equity in their home. And by the way, home prices are coming down. So are they going to be incentivized to put that house on the market to extract that equity? Absolutely they are, right? And then going back to that person that has that fixed rate mortgage, but all their other costs are going up, and then let's say they lose their job. How are they going to afford those additional costs, even if they don't lose their job? So you could have, and you likely will have, all this forced selling going into a recession. Now, why does that matter? Let's focus on the single family side, and I would assume it's probably the same on the multifamily side as well, but supply is at an all-time low. So this is what they perceived to be a bullish argument. In my opinion, it's a bearish argument, because it puts the market in a far more precarious position, even in terms of nominal prices. Let me tell you what I mean. Okay, so let's pull up this chart. This is from this guy on Twitter. The handle is at Kobisi letter. I don't know who these guys are, but this is a fantastic chart. So this is what I always pound the table on. It's not just home prices relative to historic home prices just for inflation, but it's home prices relative to incomes. Because at the end of the day, the home price is a derivative of incomes, because interest rates are always going to equalize. They kind of mean revert. We see an average there. And even if interest rates go down, that doesn't mean that money's loose. Most likely money's tight, right? So look at what we had from, let's say, 1970, Kenny, to the end of the 1990s. Look at this.
Yep.
The price to income ratio was hovering right around, let's say, 2.7. And going back that far, we have an average of right around 3. Now let's look at where we were in 2006, when there's no one on the planet Earth that would argue we were not in a bubble. We were at right around 4. Okay, where are we today? Right around 4.5. You see, now this is why I always say that prices eventually will likely come back to where they were in 2012. When I say that, people's head explodes, right? They say, what are you now? You're crazy. What are you talking about? That's impossible. First of all, I'm talking about real prices adjusted for inflation, not necessarily nominal. And then I'm just looking at this home price as a derivative of income. So if you're going to argue that incomes will stay the same over the next year, 2, 3, then you also have to argue that home prices will have massive downward pressure and will likely, or, well, I shouldn't say likely, but you can have a strong argument as how they will trend down toward this mean of, let's say, this ratio of 3, because at the end of the day, home price is a derivative of income. And if income isn't going up, if you have this massive delta, we always see it mean revert.
So what happened I love the article you put up earlier, because what happened in 2008, 9, 10 for us is people were losing their homes. As you remember, the single family home market was, it was called jingle mail. They were mailing their keys back to the bank, right? So all those people were being displaced into rentals. And that's actually what created this boom on the rental side, and as you can imagine, there's no construction, no supply being added during that period of time. When a bank's taking water on the boat, they're definitely not lending, So we went through this period of time where there was almost no construction. You think about, nobody thinks about the lack of construction or the lack of supply that was added in 9, 10, 11, 12, let's call it 13. If you really look at it, you'll see it wasn't much, because banks were, taking it on the chin. So all we've really done is catch up with that excess supply. But, we're kind of at this point, it's not healthy or normal to be at 95 and 96% occupancy nationwide. That's not healthy. Mm-hmm. What's healthy is in the low, the low 90s is healthy, because the consumer is supposed to rent and then go to a home and build equity in the home. That's kind of the natural progression. Not in all cases, of course. Some people rent by choice, and depends on their circumstance. But at the end of the day, things are very disrupted right now, because rents are, $2,000, and we just saw a minute ago, the home mortgages plus all the extras, you're over $3,000. I don't see any relief in sight for either one of these categories.
Yeah, but keep in mind that their numbers now and their positive or negative cash flow is based on that 95% occupancy rate.
Right.
So let's just assume for a moment that we go into recession and that occupancy rate goes down to just 85, which I would assume would still be historically high. That's a big problem if you're still negative cash flow at 95% occupancy.
You made a bold statement that you believe that we're going to have a banking crash, not just next year, but March 11th.
By the March 12th, March 12th,
March 12th, sorry, of 2024. Can you walk through that?
For your viewers who don't know what the BTFP is, this is the Bank Term Funding Program. And this was basically the Fed bailing out the banking system back when Silicon Valley Bank went bust in March of 2003. I think that they came out, March of 2023. I think they came out with this March 12th. So the reason this is important is because it expires. This is not a permanent program. This expires March 11th of 2024. And I could be a day off there, I'm doing that off of memory. So I don't think there's anyone that would argue that if the Fed would not have come to the rescue, that we would have legitimately had a banking crisis in the United States very similar to what we saw during 2008. I think pretty much 90% of the people watching this would say, yeah, that's definitely true, especially when you consider the banks that did go bust in 2023 exceeded the total amount of assets on the balance sheets of the banks that went bust in 2008. So there's an argument that the banking crisis of 2023 was even bigger than the one of 2008 when you look at the actual balance sheets of the banks that went bust. But setting that aside, with the systemic risk and all of these things that we know is a part of today's monetary system, I think that everyone would come to the conclusion that, yes, if the Fed would not have stepped in, the stuff would have really hit the fan, and we most likely would have had another financial crisis. Okay, well, back then, Kenny, let's go ahead and just do a
I was
5 years.
Yeah, otherwise they wouldn't even have set this up, right?
Right, exactly. If the banking system didn't need to be bailed out, why set it up?
Right.
To your point. So here in March and April of 2023, we see this utilization of the Bank Term Funding Program that was the Fed's bailout went directly up to about $80 billion. And what happened is this allowed the banks to take all of their treasuries that took a massive haircut and get 100 cents on the dollar by giving them to the Fed. The Fed would give them a loan, and then they could afford to transfer their deposit liabilities to another bank, i.e. bank run. Okay? So that's kind of the mechanics behind what's happening. And most people, to your point, Kenny, that no one's talked about this. It's completely out of the news cycle. Nobody thinks it exists. In fact, if you ask the average Joe and Jane, they would assume that, hey, this banking crisis, that's something of the past.
Yeah.
Why are you even talking about that, Kenny? The Fed handled this, don't you know? And they would assume that the Bank Term Funding Program went straight up to $80 billion. It took care of the problem. Now all the banks had plenty of time to fix their balance sheet, and then it went right back down to zero because we haven't heard about it in the news lately. But look what happened in reality. We went straight up to $80 billion, and now did we go back down to zero? No. We went straight up to 100, and now as we speak, Kenny, we're at 121.
And
so the Bank Term Funding Program did not go down to zero. It went up, and it kept going up and up and up and up, where we are today at an all-time high. So if the banking system is healthy, why has the Bank Term Funding Program, basically the bailout of the banking system, continued to increase?
Awesome, George. Well, I've kept you long enough. What's the best way people can reach you?
Oh, they can just find me on YouTube. George Gammon is the YouTube channel where I do the whiteboard videos. And the Rebel Capitalist channel is my other YouTube channel where I just do live streams based on the daily news.